That was pretty funny. The timing of it was funny because all I heard was, "How come it hasn't interrupted us yet?" And then you were gone. So I like that. Anyway, welcome to Tradiers, the Trader's Edge. I am Jim Iuorio. That's Bob Iaccino. Bobby's coming to us from Naples, Florida right now. And if you guys don't live under a rock, you know that there's some heavy winds going right now. You think you're going to be okay, right?
Yeah, I mean, fingers crossed. Yeah. You know, we've got a newer house. We've got hurricane rated windows. We got hurricane rated sliding doors.
Are you on stilts? No, right?
We're not. And we're not that, I mean, we're obviously above sea level, but we're not that elevated. But, you know, when it came time for us to move here, there was a choice between spending a lot of money for a smaller place that was closer to the water or a little less money for a place that was further from the water. I have had friends that have said to me, you know, you don't even live close to the water. I'm like, I'm a 15-minute car ride. I used to be a 2.5-hour fucking flight.
And then an hour drive, right?
Yeah, and then a 15-minute or an hour drive. So the way that I look at it is it's now actually a selling point to have a newer constructed hurricane windows, cinder block house that's far from the water where no storm surge. It's virtually impossible for a storm surge to reach us. It could happen. And since it hasn't hit yet, I'm going to knock my wood.
As soon as you said it, I was knocking over here too. Right?
But the windows are 130 mile an hour rated and supposedly like a 9-pound projectile moving at 34 miles an hour is supposed to not be able to get through our windows. There'll be cosmetic damage though, likely, because the winds are on the dirty side of the hurricane. So it's supposed to be pretty high winds.
Right. Normally when we start the show, we talk a little bit about what our takes are too, but let's just bring our guest in, right? Is that okay with you? So yeah, you guys, as I said this a million times, and never is it more true that at this moment, you may have been following Bobby and us for 20 years and think that most of our opinions are bullshit, but you cannot argue that we get good guests. We don't know why they say today is not going to, why they say yes, today is not going to disappoint you. We have one of our favorite guests, Luke Gromen, founder and president of Forest for the Trees and author of 2 books, Interviews with Mr. X, volumes 1 and 2. I'm not sure if I got those right, but Luke will be here right now to tell us if I did. Before, when we were in the green room, Luke and I were both talking that, and I'm not glad, but when hurricanes happen in Florida, it always seems like us up in Chicago and in Ohio, we get spectacular weather. Are they linked? Are those things, like, is it a pressure thing? Like if it's hurricanes down there? Because it always seems that way. And I'm not even joking. Our weather's fantastic. Yours is too in Ohio, right?
Oh, it's been unbelievable. It's been like 70 to 80 degrees all October. So it's now we usually get like a tail, kind of like a tail snap of it once it heads into, so like that stuff, unfortunate, hit North Carolina. We got like a couple days of rain, you know, that was the extent of it. But other than that, yeah, I don't know if it's a pressure thing or what, but yeah, hopefully everyone stays safe there. But for the moment, it's gorgeous here, not a cloud in the sky.
Well, yeah, 75. No doubt. Yeah.
Yeah, it's funny because, I mean, obviously I spent the majority of my 58 years, I know I look great, in Chicago. And September is the month we chose to get out, have an outdoor wedding, my wife and I, because it is just gorgeous in Chicago in September and October. And this is the time of year where my relatives that I left in Chicago, I was like, you okay? See, that's why I don't want to live here. The northern media tends to, I shouldn't even say it because they're
don't say it today. He was going to say exaggerates, but keep off and knock on wood.
You don't know what I'm going to say here because you're wrong just on the basis of what you said. Even down here, they're saying things like, what could happen if the storm hits at high tide in this particular place? We got 200 feet of water and it's Noah's Ark and you're all dead. They even do that down here, right? And it's just very similar to people like, I tend to be one of those people who are like, we're going to be fine. This is my 3rd hurricane since we've lived here. But I'm also very similar to one of those people that move into Chicago or New York City and be like, hey, the crime's not bad. Yeah, until you get murdered, right? So it is a high probability that at some point we'll have a hurricane that we're pretty mad about, but it's not likely to be this one. It wasn't Ian. So far, so good. It wasn't Helene either.
Yeah. Well, good luck. It's kind of scary. Hopefully it works out good. You'll know in a couple hours, right? It'll pass over.
Yeah, it's hitting us tonight. Part of the reason Luke requested we do this an hour earlier, and I was all about it because I should lose power any minute. As a matter of fact, I may not be able to finish this show.
So let's get on to some interesting stuff. I want to go right kind of to the meat of the bone right away. Luke has written a lot about the dollar and the trajectory and the spending and the two candidates. I don't mean to misquote you, and tell me if I do. You are slightly more towards an eventual actual de-dollarization happening around the globe. Eventual. Is that accurate to say that?
Yeah, I think that's fair. I think it's a slow but accelerating process, and I think it's centered primarily in the commodities markets, which is really where it matters the most. Which is to say, is Chinese trade being de-dollarized en masse? No. Are they buying more and more of their oil, or have the option to buy more and more of their oil outside the dollar? Absolutely, they do. They've been buying it from Russia for outside the dollar for going on 10 years, and quietly in November of last year, China and Saudi signed a bilateral currency swap. Now, what trade could occur between China and Saudi that would require a yuan Saudi real?
Call on me, I know.
I'll give you 3 guesses. I don't think you're going to need all 3, right? So it's happening, and that has a very the de-dollarization of the global, starting with oil, but commodities more broadly, has a very predictable set of knock-on effects that have been very observable, and a lot of them are contrary or paradoxical. And so when a lot of people, if they don't want to get any deeper onto this, say, well, de-dollarization isn't happening because the dollar's going up. You said, well, no. De-dollarization would drive the dollar up mechanically. That's literally a symptom of de-dollarization. So there's a lot of things to dive into, but yeah, I think it is happening. I think it's necessary. I think there's certain parties on either side of both sort of the U.S. and NATO and, the BRICS and global South that are both in favor and not in favor of it. And, you can kind of dig into each of those from there.
So again, a year and a half ago, I started putting on pretty heavy positions in gold, silver, platinum, crude, all the de-dollarization things. And it wasn't because necessarily I agreed 100% with you. I thought that there was enough people around the globe who worried about the potential for it to happen that it would boost those commodities. So far, it's been a good trade. I have no intention of turning that around. Let's flip to the election real quick. Both of them, it seems to me like you got a profligate spender versus a profligate spender. But you got one who potentially could be a deregulator and one who is a regulator. Is one of them better for the dollar? And I know the answer to this question. Go on.
I think one's less bad for the dollar. I think Trump is less bad for the dollar. I think either way, the dollar is likely going to be lower, probably by quite a bit by the end of the term of either of the two candidates. And I say that because ultimately the Department of Defense wants, needs, and will drive a lower dollar. It is no longer in America's interest to have a strong dollar anymore. When you hear people say, well, the Russians are out producing us in the Ukraine and we can't, we need to produce more of our own semiconductors and we can't go to war without China, which is a problem because they're afraid we're going to go to war with China. All of these things are different ways of saying the same thing, which is the dollar has to go a lot lower because the flows that have supported the strong dollar are the flows that have led to the hollowing out of the U.S. defense industrial base that is now so bad that we can't fight an industrial scale war against our real major power because our industrial base has been hollowed out by the strong dollar. And so the Defense Department, certain intelligence interests want a weaker dollar, And in my opinion, it's always been a bad thing to bet against the guys in America with haircuts like mine and very.
That's not a haircut. There's a certain amount of things that okay. Anyway, when you say about the industrial base, and I just want to get one quick more question. You mean because of the stronger dollar, we have tended to get all our important metals, all our important mining, all our important shit from other places. And in the event of crisis, global geopolitical crisis, that might be turned off for us. That's what you mean, right?
Absolutely. I thought there was a fascinating article in the Wall Street Journal last week, which highlighted that part of Kamala Harris's economic plan is to reshore the mining of metals like nickel and cobalt. Now, set aside the fact that this runs 180 degrees counter to everything she has stood for her entire life. When you layer in that between that has disagreed with her entire lifetime of politics. Okay, so why is she saying that? Well, and why is she saying that when I get the sense, and when I say I get the sense, I've been told, like, I don't think she's paying a lot of attention to nickel or cobalt. I think someone is writing that for her. And I think the people that are writing that for her are the people that are also writing the assessing the defense supply chain Defense Department white paper in October, released in October 2018 for the Trump administration, which pointed out that the United States is dangerously single sourced on a dangerous percentage of its defense industrial base to China. And so those same people are writing the same stuff. So to me, it's really 6 of one, half dozen of the other, which is we need to reshore. I don't think it really matters who's president is going to be. The dollar, I think, will go lower. I think you can make a case it'll go a little less lower under Trump than under Harris, because I think, and these, I don't want to totally get into the politics of it, but I think around the edges, there are more unproductive industrial policies or more inflationary industrial policies where you're going to be doing more sort of EV type stuff rather than sort of core thrust industrial energy than you would under the Trump administration. I could be wrong about that, but I think that difference means the dollar would fall less under Trump. But I think the dollar is going lower as a matter of U.S. national security either way over the next 4 years.
Luke, before I ask my question, Daniel, who's one of our viewers, put a post up that I'm not sure it affects you or if it means you or me, since you're wearing sort of a dark coat and I'm always black and gray. But I think that's because you and I are always negative. He kind of has a good haircut too. Daniel.
Let's call out Bones real quick, because Bones has been in Tennessee trying to bring supplies to people who've been affected by the hurricane for the last week. Thank you, Bones. You're a good man. But anyway.
Yeah, Bones, you're part of our inspiration too. Jimmy and I are working on a project to do the exact same thing through our couple of shows. So there'll be more on that in the future. My question is this. My very first economics class in college, section 2 of the textbook, currencies, right? Currency relationships. The very first line, I remember it vividly. Buying a currency is like buying a share in the economy of that country. I don't think that's true anymore, is it?
I don't think it's true anymore. Once you started, once you started sort of globalizing supply chains, right? So what is a share in America, right? So when we have when it was, 1975, 1980, and we had a quorum of our industrial base here because it had to be, because we were in a Cold War with the Soviets. Like, okay, a dollar is a share of the country. Now, post China and the WTO in particular, what is it? What's a dollar, right? We run deficits here. We offshore the factory and the jobs over to China. They send us stuff. We send them, that is ostensibly an American company. We send them dollars to pay for it. They send the dollars back here to essentially recycle into our capital markets. And that's an arrangement that has empirically been very good for Wall Street over the last 25 years. It's been very good for Washington, D.C. And you can kind of go chapter and verse, look at the wealthiest counties in America in 1995, pre-China and the WTO, and compare them to them today. And there are way more Washington, D.C. and Wall Street counties in the top 25 wealthiest counties in America than there were in 95, 85, 75, 65, so on and so forth. So there's a very definite set of winners and losers. And again, that's fine up to a point. But as with everything, the success of a system breeds its own failure, which is once you are dependent on your own national security components to somebody who may not have your interests, and set aside even the national security component to it. If the deal is we're recycling Chinese profit dollars into our stocks, then technically we're selling our stock market control of American corporations to the Chinese in return for payment for American or for goods in return for the Chinese financing American deficits, essentially. And that's you're hawking your family silver. You're eating your seed corn, and you can do that for a little bit, but once you get to a certain point, it's very problematic. And I think we're past that point where it's problematic. And so I bring all that up as a way of background is what is a dollar? A dollar is now a share of that entire dollar recycling machine, which is China is the factory of it. And then in the middle of the country has been hollowed out in America, the manufacturing base. So but it's we're basically a giant hedge fund with a military attached to it and a big insurance company attached to it, while the Chinese and Asia more broadly sort of makes everything for us. So that's what it is now. That's the company it's a share of. It's back in 1980, it was a share of a very diversified and pretty self-sufficient entity, and that's no longer the case.
And the reason I asked that question is because I remember thinking when I heard that, I said, okay, I know I'm going to trade something in the future, despite starting my adult life working in my family business, my father's family business, which was food service. And when I got into this, I was like, okay, currencies seem easy. The economy's either strong or it's weak, period. Not even close anymore. Like not even close. It's central banks, it's quantitative easing, it's military dominance, it's de-dollarization, it's all these different things. I barely touch it now, to be honest. I barely touch it unless I see a massive divergence between central banks, which brings me to my follow-up question. ECB, multiple speakers the last couple of days saying we're getting another cut, right? Fed, going from a 54% chance of a 50 on November 7th to a 15.5% chance of nothing, right? That's seismic, isn't it? In the context of the Fed, is that overreaction, or which way do you think is more believable that will happen? Not what you think should happen, but that will happen.
I think there is a tactical answer to that and a secular answer to that. So the tactical answer is,
love that.
is look, we were on record all year saying I think there's like zero chance the U.S. is going to have a recession. And the reason I said that is we're running 7-8% fiscal deficits, which makes it almost impossible as it is. But then when you layer on top of that Americans 55 and older have $114 trillion of wealth, 70% of the wealth. They're by far the wealthiest generation in human history. And these people want to spend that down before they get sick and can't, or die and can't. And so you basically have a $114 trillion piggy bank spend down, what we've repeatedly called for over a year, the biggest YOLO spending binge. You only live once spending binge in the history of mankind.
By the government, not these retirees.
Oh, no, by retirees. By
retirees. Okay, go. Yeah.
Right. So it's right. So you've got a situation where the U.S. government's running an 8% fiscal deficit. And a big part of that fiscal deficit, by the way, is the fact that the U.S. government is sending boomers 70% of U.S. federal tax receipts in entitlements every month. $3.3 trillion a year, which is, 14% of GDP right there. Here you go, boomers. Enjoy. And that's all just added to the debt. That's fine. There is a trust fund and that's against whatever. But that is sort of, going from off balance sheet by and large to on through income statement, right? And then added on to balance sheet. That's the accounting of it. So you're getting 14% of GDP in entitlement payments. Then you're also getting $114 trillion in savings where, like, go to a restaurant. I guarantee you I would be shocked if it was not a case where every restaurant you go to, every time you go is full. It usually needs a reservation and there's nobody there basically under age 50. And so you're getting this bifurcated economy, which is the boomers are spending what they got while they can and getting a huge check every month as a generation from the government as well. And they're spending it while the lower end economy and younger people are struggling. And so that led to this sort of, narrative of like, look, if we focus on the data of the younger people and the low end, the economy looks terrible and we should be cutting rates. And if we focus on the overall economy, what the boomers are doing and getting from the government way overshadows it. And we're running 5-6% nominal GDP growth, and we're going to continue to do so. So tactically, I don't think they shouldn't have cut. The Taylor rule said they should have raised rates by 25 basis points, not cut 50. And so tactically, I think that's probably right. I think the Fed's kind of stuck now. They're not going to be able to cut again. Now, with that said, secularly, why did they cut? That is the elephant in the room to me, which is they had to cut because the U.S. fiscal situation is now so bad that they need to get the stock market juiced so they can get tax receipts back above what I call true interest expense, which is just your interest plus your entitlement pay goes, right? So in August, if you added up the U.S. government interest plus U.S. government entitlement payments, they were 150% of tax receipts, 150. In July, it was 120%. Those are off months for tax receipts. So let's see what September, where it comes in. But year to date, fiscal year to date, which just ended September 30th, is right around 100%. So basically, if you consider entitlements as an interest expense on the off-balance sheet liability, which I do function, I have an accounting degree. That's all it is. Let's call things what they are, not what they're, not what they sound like or what they say they are. Your true interest expense of interest plus entitlements is about 100% of receipts. So you got to get receipts up. And in America, because we don't make anything on net anymore, the only way to get receipts up is to juice the stock market or reduce interest expense, and ideally both. So what's the easiest way to juice the stock market and get interest expense down? It's cutting rates. And, since they couldn't cut entitlements, they couldn't cut defense, here we are. So to me, when I then look at it secularly and go, okay, tactically for the next month, 2 months as a trader, I think the dollar's probably bid, and I think stocks and I think markets remain volatile. Ultimately, they go higher because I think the economy is going to be much stronger than people think. And that makes sense to me. Secularly, I don't know when it's going to hit consensus that, oh my God, they should be raising and they're going to cut, or they can't raise because the fiscal situation is there. Then I think we'll get a follow through on the dollar that we started to see. We've seen the dollar go from 114 to 100 very quietly over the last 2 years. It's bounced to 102. I think it goes to the low 90s over the next 12 to 14 months after this 1 to 2 month period of tactical bounce we talked about from a trader perspective. Once people realize what is factually, mathematically true, which is they're cutting rates because the fiscal situation requires them to do that.
I want to point out real quick before I give Jimmy the next question. So currently on our live audience, we are beating the Daily Wire's coverage of Trump in Scranton, PA. The only thing we're not beating is Trump's actual coverage of his own rally in Scranton, PA, which we're losing by about 186,000 people. So all of you guys that are watching right now, free to ask questions, please do. We got Luke for about another 30 minutes. But Jimmy's question right now, I have tremendous confidence it's going to be groundbreaking.
It's going to be absolutely groundbreaking. Because by the way, I wanted to add to what you said too, Luke. Sometimes we have as many as 8,000 people watching this live. It's not even designed to be watched live. You know what I mean? No. It's a podcast that's supposed to be packaged and consumed over the next week. So we are destroying legacy media, and nobody's happier about that than me. I will not rest easy in my grave until we grind legacy media into the dust. My question, however, though, is this. My base case, I talked about why I started to get more into materials, gold particularly. I believe this is going to happen. You mentioned a completely untenable fiscal situation. Just next year, just debt service is going to be what? $1.4, $1.5 trillion, just debt service for 2025. My belief is this, is that over the last 6-8 months, we have seen several long end auctions that have not gone very, very well. Now, the Fed, I mean, the Treasury seems to be using up much of its short-term options. They've tapped reverse repo. They've probably tapped their Treasury general account too. When they start moving out to the long end to service the debt, I believe that the curve is going to steepen. I believe the curve is going to steepen hard because 10-year rates could go as high as 6% over the next year. I believe at that point in time, the Federal Reserve will switch back from QT into QE. And that part, I'd love to be dramatic and say game over, but I don't believe it's game over. But I believe that's the point in time where people understand what you're saying about the dollar going lower, and shit like gold and real estate and silver, it could potentially go through the roof, and Bitcoin. What do you like or dislike about my thesis?
I think directionally, I agree with much of it. I think there is a lever ahead of time ultimately, and some of that ties into what you just said about reverse repo, TGA, where they place it on the curve, which is to say, you tell me where the dollar is and I'll tell you where the deficit is. In other words, if the DXY is 80, the deficit's probably going to be 800 billion or $1 trillion. And if the DXY is 107, the deficit's probably going to be 3 trillion, and we're probably going to be right back to the fun days of late September 2023, where we were going into a United States debt spiral. Come in, call up your screen, 10 years up 10 basis points, Dow's down 300, S&P's down 1%, dollar's up, close screen, come back, do it again, until we had right at the end of September, early October last year, what happened? 10 trading days, 7 different Fed speakers came out and said the bond market's done our job for us. Few weeks later, Yellen shifts issuance to the front end. Dollar goes down meaningfully. Stock market goes up meaningfully. And voila, we're able to sort of smooth things over. So
you think when she shifted to the short end, that was a bit of fear, correct? From the long
end?
100%.
100%.
Keep going.
Yeah,
I
think people make this more complicated than it is. When they talk about the terming, right, there's this big discussion of, there's been no problem at the long end. Well, of course there hasn't been. They've shifted it all the front end.
Yeah, all the front end, exactly.
Right? So you have to believe that. It's a little disingenuous when people make that argument, in my opinion, because you have, right, the long end was at 1-2%, 3%. And so either Janet Yellen is stupid and didn't term it out. Janet Yellen's not stupid. Not at all. In fact, I've been very impressed with her in terms of her ability to sort of juggle all these plates. So if we assume she's not stupid, then the only other answer is, had she termed it out, the long end already would have blown out. That's the only other answer. And so
bingo.
We can see this dynamic of, you tell me where the dollar is and I'll tell you where the deficit is. We saw the dollar, after COVID, we saw the dollar go down to, I don't know, 90, 91, maybe something like that. I want to say on DXY, if I'm just going from memory. And we saw the deficit go from 3.1 trillion down to 1.4 trillion, something like that, 1.2 trillion in a year. Some of that was reopening, but a lot of it was affected. Nominal GDP was running like 15% with 7% real and 8% CPI. And that's fine. You can do that. That's how you get the deficit down. It's just a question of what decisions you want to make. Flip side, in 1 year, in 22, they raised rates. Dollar went up to 114, 115. In 2022, we were starting to have treasury auction problems. The Move Volatility Index, which the creator of that index, Harley Bassman, said in fall of 22, this thing at 150, 160 is telling us the Fed has lost control of the bond market. You can't trade bonds when the average move is 9 basis points. I mean, it was crazy. And when they did that, dollar went to 115. Where did the deficit come in 2023, the next year after they did it? The deficit doubled. It went from 1.2 to $2.1 trillion in a year. And it was fascinating to read in September 2023, Washington Post and a number of different major, mainstream financial economists were like, wow, this is really amazing. How did the deficit double in the middle of a recovery? Simple. The dollar went from 91 to 115. This isn't hard to figure out. So that's why that's the one thing I would say. There's a little bit of a chicken and the egg kind of dynamic to what you laid out, Jim, which is Yes, and if they move the dollar around, if they get the dollar low enough, then you can get, in an orderly manner, right? I mean, there's limits to it, and I think each time they play with this lever, they get less and less flexibility, right? But that to me is really the key: is where's the dollar? I'll tell you where the deficit's going to be.
I love that. Okay, so tell me this. Then this one more question for me, Bobby. I wanted to get a take on, and then you got the next question. But not one more question for the whole show. We got tons more questions for the whole show. But anyway, is this a true statement? And I've said this before. I said it in a speech a couple weeks ago. I said the option of spending like drunken sailors, creating a crap ton of government jobs through all levels of government to boost an economy at the expense of the debt, boosting out the debt to 26 trillion or 36 trillion, 26 trillion. That's always been available to every Fed and to every government. They just laid off it because they worried that if you sail too close to the cliffs, eventually you may hit the cliffs. That's a true statement, right?
I think that's fair. I think there has been a political consensus in this country since the early to mid 80s that has been subjugate the American middle and working classes in order to support the bond market, Washington deficits, and Wall Street,
and make us richer.
Right. So I
think it's great policy. No, I'm just kidding.
Right. What was, from 1900 to 1970, what's good for GM is good for America, turned into what's good for Goldman Sachs is good for Washington and Goldman Sachs. And that was fine because everyone else was kind of getting dragged along somewhat. Everyone got cheaper stuff from China. And so no one complained at first, especially while, I lost my job making $40 an hour plus benefits at GM. But, on the upside, I'm now a greeter at Walmart for $12 an hour, no benefits. But I did get this awesome subprime loan. So I can still go out and buy my bass boat and go take the family on a vacation. And then, of course, after 08, the subprime market went away. And now all that's left is, all right, now I'm a greeter at Walmart for $12, no benefits. And sort of Wall Street got bailed out and I didn't. And a few years later, we get Trump and political populism. And so kind of here we are. So that is like the sort of the flip cartoonish background to this political consensus in Washington, which was what's good for Goldman Sachs, what's good for the bond market is good for America. And we must subjugate the middle and working class by sending their jobs to China in order to keep inflation low, to be able to finance American deficits at affordable rates, and to keep Wall Street doing well. All of that was fine. The military and the teens kind of started going, hey guys, China's weaponizing our debt against us. And it's a bigger threat than weapons of mass destruction. It's a bigger threat than climate change. It's a bigger threat than terror. And that's not me saying that. That's the former chairman of the Joint Chiefs of Staff, Admiral Michael Mullen, saying that in 2011. But the military is kind of quiet about it. And then where it started to really pop up was when Trump got elected, and that he really turbocharged this. And then I would say there was still a minority in Washington saying, listen, this political system of subjugate American middle and working classes to support the bond market, and what's good for Goldman Sachs is good for America. That was still a minority view until COVID. And then when Washington and Goldman Sachs and Wall Street couldn't get masks and couldn't get supply chains and couldn't get what they needed during COVID, there were a whole lot of converts from, hey, whatever's good for the bond market is good for America, and subjugate the middle and working classes, to the military's view for a decade at that point of, hey, we need to start reshoring. We need to start bringing stuff back. And at that point, so we're in this almost civil war in America of policies, which is there's still a lot of subjugate the middle and working classes to support the bond market, and sort of, the flag wavers, the flag carriers of that are still Larry Summers and Robert Rubin and those types. But there's a lot more people now saying we need to subjugate the bond market in order to support the middle and the working class, and the ability for America to basically support wage growth, to reduce wealth inequality, to reduce political instability, and most importantly, to be able to fight a war with an industrial power. Because right now we can't in any real way. We don't have the production capacity. And that's sort of the thing that's being whispered in Washington amongst people in the know that is not being said on the news. But that's why ultimately we are hearing things like Kamala Harris saying, let's build a nickel and cobalt stockpile. Like, what? Like, when you hear that, when you hear Kamala Harris talking about that as part of her economic policy, what you should hear, how you should translate that is, that's the U.S. military and intelligence establishment saying to her economic advisors, this is going to happen, so you might as well write that in. And that's and to finish the thought, that is great for industrials. That is great for America. That is great for nominal GDP growth. It's great for inflation. It's great for wages. It's great for corporate profit dollars. It's not good for corporate profit margins. They're going to have to pay their people, and they're going to pay Americans instead of paying Chinese for the first time in 25, 30 years to do it for them. And that, as a result, means the execs who, are going to have to not get Italian tile in the pool in the sixth house, and they're actually going to have to start to pay some of the line guys, like we just saw in the ports, right? Like, people like, oh, they got 60%. What, highway robbery? No, it's not highway robbery. They got 8% a year on a 6-year contract. And, oh, by the way, that 8% a year that just matches the CAGR debt growth of the federal government since 2008.
So I've got 2 more questions, Jimmy, before we run out of time. But first, I'm going to go to Daniel's comment because he put another comment up, and I don't want to miss on that. And I'd like to actually speak to this before I turn it over to Jimmy, you, and Luke. Guys, does how you participate matter? Gold, Bitcoin, electrical infrastructure? If you found a way to participate in electrical infrastructure, I personally think that's a buy and hold. That's number one.
Isn't that copper?
Yeah, copper's one way. I don't know that it's directly infrastructure
No,
because
you're right. Okay,
everything would affect copper. But yeah, but I love gold, and I don't love Bitcoin in terms of participating in things like a commodity super cycle or some of the things that could actually weaken the equity markets for this reason only. I think Bitcoin is either a long-term buy and hold or it's a speculative trade. And the reason I say that is because it has a very high downside correlation, positive correlation with the NASDAQ. If the NASDAQ sells off, Bitcoin sells off. And that correlation is not broken yet. When the NASDAQ goes up, Bitcoin does both. But when the NASDAQ goes down, Bitcoin goes down. And I don't like that correlation because you could very easily see a flight to safety into gold, and Bitcoin's right now is not getting that flight to safety as well. Jimmy, you want to take it and then give it a look?
The only reason I'm not going to say is because everybody who watches this show knows I've been beating this drum for a year and a half, and my portfolio is heavy on real estate, gold, silver, copper, all the shit that Dennis Gartman used to say hurts when you drop it on your foot, because I believe in everything that Luke is saying. I believe that enough people believe in the de-dollarization story that it could get to be dicey, as is the weather in Florida right now. But because we talked about that term before. But I'm more interested in, Luke, what are the assets to participate in what you lay out?
I think absolutely electrical infrastructure is a big one. Industrials in America are a big one. I think gold is a big one, as people frequently say, okay, well, what's going to replace the dollar? And the answer is nothing's going to replace the dollar. What is going to replace the treasury bond? Forget about what is going to. What has been replacing the treasury bond in global central bank FX reserves for 10 years now has been gold. For the last 10 years, central bank reserves have seen a $400 or $500 billion decline in treasury bond holdings and a $400 or $500 billion increase in gold holdings. And so people say, well, no one trusts anything but the dollar and treasury bonds. And that's absolutely right. And so what you're seeing is what Jeff Curry called the gold recycling trade. Buy oil in renminbi or sell oil in renminbi. What's Saudi going to do with the renminbi? Well, they're going to turn around and they're going to buy Chinese goods because China is the factory of the world. And there's a lot of stuff China makes now that is very, very good. It is world class. Some of it is better than what we offer in the West competitively. And then with any net surplus, they're going to buy gold because all else equal, gold is nothing more than a 0% yielding bond of infinite duration and finite issuance, which is much more attractive than a a finite, treasury, which is finite duration, infinite issuance, and a coupon that is below the rate of dilution, right? If the United States debt's going up 8% per year, and you're getting 4% on your 10-year, that makes you the sucker at the card table. I will borrow all the money you want to offer at 4% if you lend me 8% more a year. Greatest deal in history. I'll do that all day long. Just DM me. You can find me on Twitter. But so I think gold benefits. I think infrastructure benefits in the U.S. I like Bitcoin. I agree 100% what you're saying on the downside. It has not broken that correlation, and that I think it will at some point, but it has not yet. And so I think for anybody with a Bitcoin allocation, I think there's an energy tie. To me, it's just a neutral reserve asset with an energy link. But for anybody owning it, I think position sizing is critical. You have to understand the volatility and that downside correlation. So if you own it, then, Bobby, like you said, own it and just put it away. Own it in a size where you don't give a crap if you look up one day and it's down huge. That's fine. But so I think those are the types of real estate. I think in certain areas, certain things, I think it has to be simply because we're seeing so much change in the economy, right? Work from home is changing the nature of commercial real estate. Amazon is already 15, 20 years into changing the nature of light retail. And there's still attractive things, but it's much more, for a long time in this country, 40 years, you just buy real estate and, throw a dartboard at a portfolio and you're going to make money. And I don't think that's true anymore. But all else equal, if you've got the right piece of property, then I think that benefits as well from this dynamic, which is just a flow reversal of what we've seen, right? We need to reshore, we need to subjugate the bond market in order to support middle class, working class America and the industrial base, and that implies significantly negative real interest rates for a sustained period of time.
I'll say this, and if either one of you disagree with me, just jump in. For Dan's comment here, buy, hold, BTC would be spot versus futures. I personally, just what I do, I'm not telling you to do this, I trade the futures. I buy and hold in a wallet. And then gold, I just prefer the safe. I have guns, I have dogs, just like Jimmy does. So I just prefer the safe. I trade the futures, not the GLD. Jimmy?
Yeah, you can, if you get by the dogs, you'll wish you hadn't. That's all I'm telling you. So I'm fine with people knowing that I have gold. I do use the GLD as a trading instrument. And you said gold is non-yielding, and I'm not. You are right, but I do sell then call spreads in the GLD against my physical gold holdings. You know what I mean? So I get myself that 4% yield, but it's always call spreads because I'm playing for the big move in gold. I'd like to break down the electrical infrastructure part because I thought that was interesting as well. Because what came to my mind was copper, came to my mind was uranium. I don't give any stock picks because I'm a futures guy and that's my licensing, but I do own that UEC, the Uranium Corp, whatever. What other ways could we, besides those that I mentioned, Luke, do you think we can participate in electrical infrastructure? Silver?
So I think silver works. I also think there's an ETF. I think it's PAVE is the ticker, PAVE, that is a electrical infrastructure. And if you kind of call that up and look at the tickers in there, that's a pretty decent, I can't talk about specific stocks or individual securities either, but that is that's probably a decent sort of place to start in terms of a shopping list of doing your due diligence and fundamentals on, okay, here's what these companies do. It is astonishing the level of open field running for U.S. electrical infrastructure. And that's even before these hurricanes. I mean, I don't think people truly understand how underinvested we have been in electrical infrastructure in this country for years. I mean, I had lunch with a private electrical infrastructure exec 2 weeks ago here in the Cleveland area, and like, if we could find the people, we would buy more machines. The people being welders, being machinists. That we don't care if wages, if wages go up down the street $3, we go up $5. If they go up $5, we go up $8. Because if we lose the employee, we lose the revenues, we lose the overhead coverage on the machines we do have. And that's so we can just pass it through. So they're looking at a world where electrical infrastructure has 10, 15 years in front of it in terms of just open field running, how much demand, backfilling, lead times. I mean, there's transformers are out like 12, 24, in some cases 36 months. And that, again, before these hurricanes, like they're going to have to fix North Carolina and Florida when this is all over, they're going to have to basically kick people out of line somewhere else, because it's not just a case of, oh, we have the spare capacity, speed the line up a bit or whatever. It's literally, we're sold out for the next 3 years. You lose your spot because, someone's got some connections and, they want a transformer in Florida or North Carolina or whatever the case. So I just think it is still such early days. I know the stocks have had a big move, some of these electrical infrastructure stocks, but I think it's such early days still.
So I'm giving a speech next month in New Orleans. It's at a kind of a hard money conference, and they want the title for next week. And I'm thinking about the title, the title being The Case for Industrial Metals. And I'm going to hit on the silver thing too as part of the electrification. Copper is an obvious part of the electrification too. But here's something that I think of, and I want you to tell me if I'm crazy. And by the way, this is market research for me, because I may scratch this out of the speech, or I might make it a focal point of the speech. I'm looking at palladium. The chart palladium has just been hammered. And I think part of that is that the crazy environmentalists were like, no, we can't do combustion engines. No, we can't do hybrid. We must do complete EV. Well, that's not really working. We had Doomberg on our show a couple times, and I think he's brilliant. And he talks about the brilliance of the hybrid technology that would have been the obvious environmental step. Now, could there possibly be a movement of the needle back toward the best technology in the game that could boost the demand for palladium, and because that chart to me looks like just a little more strengths, a couple settlements, and that thing could run. Is this a good topic? Do you like it or no?
I like the topic. I think the demand for the industrial metals is going to be very good, because I just think from a practical standpoint, you're already starting to see it, right? We've seen Volvo, I think Toyota, GM, Ford, all backing down their pure EV production in the last 3 to 6 months because demand's not there, because it's just not that convenient. Now, I also think, sadly, I hope I'm dead wrong. You get a 10-foot storm surge in places and you start mixing salt water with lithium-ion batteries, a couple 100 pounds of lithium. I remember watching what it did in 7th grade science class when they put lithium on a little plastic cup and set it in water and waited for the water to hit.
Yeah.
And they don't really have the technology to put those fires out really easily. They're just going to let those things burn. So there's a lot of reasons I think it is inconvenient relative to the hybrid. So I think the hybrids, they will. That makes way more sense to me. But the one thing I will say on the industrial metals, on energy, on all of it, I think we're in the early stages of a change in commodity pricing, which is to say, we go back to the de-dollarization of commodities we talked at the beginning of the show. If oil is priced in just dollars, then as we inflate, oil and other commodities are kind of the sole release valve. When oil is priced in yuan and dollars and some in rupee, and we're seeing this, on the margin, it's being priced in currencies outside the dollar, and then net recycled into gold, that starts to shift the release valve of demand and inflation for industrial commodities out of the price of these commodities themselves and into the price of gold. And so what you would start to see is gold rising against oil, gold rising against copper, gold rising against silver, gold rising against industrial commodities. And so it's interesting when you look at the charts, that's what's been happening quietly. The gold to oil ratio was 8 barrels an ounce in 2008. It's 37, 38 today. It's up 2x since the U.S. put sanctions on Russians. Actually, more than that. It was 16 barrels an ounce when we sanctioned Russian FX reserves and really kickstarted this whole gold recycling trade. It's now 38 barrels an ounce. I think it's going to 100. I think maybe 200 barrels an ounce. Same thing if you look at the S&P Goldman Sachs Commodities Index, which is also heavily oil influenced, if I recall correctly. it's up like 4x in the last 10, 15 years. Same thing. So that's not to say I don't think palladium works. I don't think copper works. I don't think.
You just think gold works better. Yeah.
I think gold works better, right? You can see in like and ultimately this makes sense, because if oil goes to 200 as we reflate, that doesn't help anybody, because we know at 100, 105, the treasury market starts to have a problem because we have so much sovereign debt.
Right.
So we need to, paradoxically, we need to inflate the heck out of something that isn't used for anything.
Yeah.
And if oil goes to 120, 150, 200, the global economy implodes, and the treasury market, more importantly, implodes. If oil stays 70 to 90 and gold goes to 5,000, like there's a bunch of rich Indian wives and there's a bunch of rich Chinese people that own a bunch of gold. No, by the way, we need those people to be richer so they can buy more of their own stuff, so they can stop shipping it over here and crushing us. So I do think, I mean, as a trade, I think it makes perfect sense what you're describing palladium. From a structural standpoint, I think we're in early days of sort of the gold to oil commodity ratio. The industrial metal ratio is going significantly higher over the next 2, 4, 6 years.
So just before we give Bobby the question too, my last speech at this same conference last year was the case for gold, and I can't repeat it. You know what I mean? So I will keep that in the speech that yes, no, I'm still a gold bug or whatever the hell you call people who like gold. I'm still heavily invested in gold, but here's an alternative. Robert. Yeah.
Yeah. So first I want to get something on the record, because you guys talked about 20 minutes ago about the jobs report and how people are still sort of spending because they have jobs. And we all agree with that. But I want to put on the record that I think the jobs market is very fragile for this reason. And I'm reading from an article, an op-ed that Jeffrey Tucker, we all know Jeffrey Tucker from Brownstone, right? And he wrote an op-ed in the Epoch Times called "Another Look at the Jobs Report." And I just want to read this part. Immediately, I noticed several features. First, nearly half of the new jobs were part-time jobs. Second, government employment made up a substantial number of new hires. Later in the article, he says we're at a record for new government hires in this past jobs report. And then third, there's been no net job creation among native-born workers, but rather an overall loss of 500,000, even as 1.4 million foreign-born workers had been hired. Luke, you've talked about this before, so that's not my question. I just wanted to get that on the record because we mentioned the last jobs report. I want to ask about the yield curve. Now, I look at the 2s, 10s, right? And I have a database on an Excel spreadsheet I've been keeping for 7 years where I put every settlement from the 3-month out to the 30-year every single night. It's gotten tedious, but it becomes valuable at times like this. July 3rd, 2023, negative 107, the 2s, 10 spread, right? The yield spread. September 4th of 2024, positive 1. September 5th, negative 2. And then 24 straight sessions of positive, with a high being positive 27. We're positive 5 right now. Does that mean anything to you? I know what I think it means for me, but this show's not about me. This has never happened.
It's a dramatic pause. I love it. But in the meantime, I will say, Bobby, you mentioned all that without saying that your partner, Jim Iuorio, has been banging the steeper yield curve since negative 60. Right. And I reloaded again yesterday at positive 2.
I absolutely should have said that, but you left out that I've been long gold since November 2020.
You have been long gold, yeah. I said we both have. But anyway, Luke, take us home.
So the reason for the pause is in some ways we are in completely uncharted territory. We know empirically last fall, 10-year got to 5 or just short of it, and we were going into a debt spiral. And so I think 5 is the number over which that can't go. That won't be allowed to go. And we've been saying for quite some time that the Fed put this cycle, if you will, is actually a Fed Treasury cap on Treasury volatility. And you can see it very clearly in the Move Volatility Index going back basically every time back to fall of 19 after the repo rate spike, that U.S. Treasury volatility has gone over 130, 140 on the Move Volatility Index. The Fed and or Treasury or both have come in and done something to weaken the dollar, add dollar liquidity, immediately. And the release valve has been stocks, gold, Bitcoin, etc. Okay, so in the context of the yield curve, I think there are two schools of thought we're watching, which is, okay, the yield curve, what's it telling us about the economy? And I think at the long end, it can't go over 5 on the 10. So let's start there. So there are people saying, Larry Summers, hey, where neutral might be higher, when the neutral rate might be higher. Okay, go for that. Why don't you take rates to 6? Let's take rates knowing now the problem is we know it can't go over 5 at the long. It creates a debt spiral. So 5's the cap there. We take it to 6 because the economy's better than expected, higher for longer. And this, this is something we were talking about early in 23 was, okay, 6% rates at the short end. What do we have to refi? Like $15 trillion in the next 3 years, something like that. Total debt, 3.5 or 35 trillion at 6%. That's $2.1 trillion in interest pro forma on a $27 trillion GDP economy. You're talking about interest expense alone, and interest expense alone, to finish the thought, of 9% of GDP. And critically, like, that's 9% of GDP coupon payments at the front end going into somebody's pocket every quarter, every 6 months. So it's going to be real hard to have a recession when you're running, $2.1 trillion in interest payments, $3.3 trillion in entitlement payments. That gets you to $5.4 trillion plus $900 billion in defense. That's $6.3 trillion in outlays right there.
Starts to become real money.
Yeah, and like receipts right now are $5.1 trillion, $5.2 trillion, and that doesn't include education, labor, transportation, national parks, all the other stuff the government spends money on. You'd layer on top of that. So the economy wouldn't slow; it would speed up. And as it speeds up, I don't want to own 10 years. But 10-year can't go over 5, or we go into a debt spiral. So how do they do to stop 10-year from going over 5? They inject liquidity. Oh,
damn.
Well, now we can go longer at the short end. I don't think, it's not happening this month or next week, whatever. But I don't think consensus understands. This is not a 5 years from now thing. This probably isn't a 2 years from thing now. I think this is a 12 to, give myself room, 24-month thing where we cut rates, it's stimulative. We raise rates, it's stimulative. And ultimately, this is how this always ends. When the debt does eventually matter. The deficit does eventually matter. And we're pretty much there. And again, people say, oh, Jim, you had a great point. I don't want to say game over because the game's never over. Right. What does this mean in practical terms? It means, again, you tell me what the dollar is, and I'll tell you what the deficit is. The deficit's too big. Not with Dixie at 80. Not with Dixie at 70.
So knock the shit out
Dixie 60, we might be running a friggin' surplus.
It's a great point. And it's a great spot to end on, too. We could talk to you for 2 hours, by the way, though. I mean, I love hearing your takes on things because I think they're so spot on. I'm amazed by it. Show them where to find you. It's on Twitter at what?
At Luke Gromen, LukeGromen, and FFTT-LLC.com on the interwebs.
On the interwebs. Right. Bobby?
Yeah, I want to tell you guys, Asia, thanks for inviting some people here. She's got a quick question if you have time for it. Where do you stand on the CBDC?
I think
you don't have to ask me where I stand on the CBDC. Right?
I stand on the same place I did a year ago on CBDC. CBDC, you might as well take the Constitution, light it on fire, watch it burn, and stomp it out in a trash bin. It is the end of freedom.
Of course, and read in history, societies throughout history. The only reason governments haven't had total control of the people because they're the inability to surveil and the inability to control all payments. As soon as they control those things, which surveil they do immediately, they'll literally, there's never been an instance where government didn't have too much power that they didn't abuse it. And that will be this. I mean, it is silly that we're talking about it. This is our hill to fight on. You don't think I'm being overdramatic, right?
No.
I don't. And I think anybody who does, I would encourage them to give that power to the other side, right?
Yeah.
You know, if you're a Harris supporter, imagine giving Trump that power. If you're a
The
Trump
city of
supporter,
New York,
give Harris that power. And that's it should be one of the few things we can all agree on these days. We should be able to agree on more. We should be able to agree on that.
The city of New York actually tried to say you can't drink big gulps. Don't tell me the federal government won't do something with the CBDC. I want to thank Shane for coming, I think for the first time. Daniel, you're always a good participant. Widge, always a good participant. All you guys. We had over 6,000 people live during this, actually about 6,300. And Asia has a lot to do with that. By the way, Luke, if you don't follow Asia at Paris of Prayer, you should. She's one of the great independent, actually center out there.
Yeah, she actually understands. She disagrees with us on some and agrees with us on another. We love her. Yeah.
Daniel, all you guys, Jimmy, it's all yours.
Okay, I gotta go, people. I got work to do. Anyway, thank you for joining us. This is Tradiers, the Trader's Edge. I'm Jim Iuorio. That's Bob Iaccino. A couple things I want to say too, housekeeping things. Thank you guys so much for your support. It is humbling. Remember what Bobby and I are trying to do. We were in legacy media for 20 years each, essentially. And every time we were there, we were at the whims of overzealous producers or of sponsors. You can't say this. You can say that. You should say this. We thought it was all bullshit. So remember what our mission is. It's just a mission to drive all legacy media into the goddamn dust. And we are going to do it with your guys' help. Thank you for the DMs. Thank you for the retweets. Thank you for all your help. Oh, I can hold a grudge. I'll be on my deathbed going, did we win? Did we crush those guys? Is Mary Duffy now going to get my dry cleaning? Because that's what I want. Okay. Thank you guys for joining us. This has been the Trader's Edge.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.